Good morning, everybody. Welcome to the Options Trading for Income Weekly Update for January 26th, 2015. Before we get going, I would just like to remind you that the presentation is for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that the risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. And we are also using hypothetical computer simulated trades in the presentation, which are believed to be as accurately represented as possible. However, actual results may vary. Come on over to our website, check out our programs, Zen 3, Bearish Butterfly, ROCK, M21 Group Coaching, Trading Triangle programs. Also, please join our mailing list to get your free report, 7 Secrets to Becoming a Successful Trader, and sign up for this free weekly webinar. All right, let's just kind of take a look at what's going on. So here's our chart for the Russell. We were here last week. Again, we got the Monday, Tuesday, Wednesday, Thursday, Friday. We got our bounce off of our more primary support level here. We bounced up to our resistance level. Again, this is a primary resistance level. Would we be surprised to see the market come up and test new highs? No. Would we be surprised to the market turn down at this point? No. The reality is we're just kind of in this wide range of chart right now. A little bit unpredictable. Nothing in this range from 1150 to about 1190 means absolutely anything. As we break over to that range, we're more likely to come to the 1220. What's a little bit more interesting is where we are in the SPX. Again, we got a pullback. We came up. We completed what we call our U here. Pretty much normal. We're still a little ways from our primary resistance levels in the SPX, and that's pretty much the case for the Dow and the NASDAQ as well, right? So essentially, there's really nothing that means a whole lot as far as movement now. The good part is if you look at your NASDAQ, you look at your Dow, you look at your SPX, they're all in the top third of this range. The Russell's kind of hanging back a little bit, which essentially tells me that I'm not really concerned about the Russell getting too high until I see probably 2 of these indices actually break out to new highs. And that should happen before the Russell gets to its resistance area. So we're going to have a little bit of lead time as far as seeing a breakout any higher. So, may we come up to this 1220? Yes, we might. Are we going to go higher than that? Very, very unlikely unless we're first led through some of the other indices. What this looks like right now is the Russell's kind of putting in what we call a complex head and shoulders topping pattern. You can see that also in the SPX. This would be also a complex head and shoulders topping pattern we're putting in, and that's fairly prevalent on the Dow as well. So technically, from a purely technical standpoint, that tends to be leaning towards the bearish side. That said, we've seen these topping patterns fail repeatedly time after time in the last 3 or 4 years because the market has just been so darn bullish. So I wouldn't put a whole lot of merit into that. I mean, people, like I said, people say, hey, why don't we look like we're putting in a topping pattern? Yes, we do. And yes, these patterns have failed repeatedly. So, the amount of merit, not so much there. So right now, we're just kind of expecting more sideways, random movement, unpredictable movement in the marketplace. Should we start to see the indices break to higher highs, then the Russell's probably going to follow, and we're probably going to go higher. That'll give us some more indication on direction. Also, keeping that in context, the Russell being the weakest of the indices probably will be the first one to break down. So just keep that in mind. All right, so coming in here, if I take a look at my option view, let's take a look at our positions here. Not a whole lot of movement in the February positions. We did enter a bunch of March positions, so we'll go ahead and just kind of go over those things. The February V Condor essentially had no adjustments until Friday, and this is before the adjustment on Friday. The position's up about $3,000. Delta is relatively flat. Theta is good, Vega is good. no need to do anything here. But with the market in this choppy sideways range, I just decided to pull the straddle out. And what that's going to look like is this. I come to my analyze graph. It's just going to look like this. And technically, I should be able to let this expire at a little over $5,000, between $5,000 and $6,000. And did I need to do this? No, I wasn't really prompted necessarily by rules-based. My theta was still good. My vega was still good. I just don't see the need for leaving it in there because my more belief is we're just going to stay in this choppy sideways range. We're not really going anywhere. We may make another judgment call later on. Should we get a breakout in the Dow or something to higher highs? We may want to get that straddle back in there. But for right now, perfectly fine the way that it is. Very likely we'll just kind of settle it here. And I'm just kind of getting rid of the inefficiency in the trade. So that is where I'm sitting with the V condor at this point for February. If you want to look at the T-log, here is essentially where we pulled out our straddle on Friday afternoon. If we take a look at our next position here, we have a February bearish butterfly, which had no needs for adjustments whatsoever. Here's our position here. Realistically, by bearish butterfly guidelines, nothing to do till we hit a delta theta ratio problem or a maximum delta issue, or we get up to, since we're at, let's see, 1190 with our shorts, till we get up all the way up to 40 points over that, 1230. So realistically, we'd have to be up in the 1230 to do anything by bearish butterfly guidelines. If I want to hedge off that risk to the upside, I can essentially take this position and put it under M3 delta guidelines and start hedging off this upside really at any time if I wanted to do something like that. Would I do that this month? Probably not. I just don't think the indices are going to break any higher. I think we're due for some more sideways movement, and it's going to make it fairly good for this particular trade. Can I be wrong? Sure. I mean, we can be wrong and it can go up. If it gets too aggressive, I could, if I wanted to, depending on how close I am to expiration, right? I'm only 28 days to expiration. We know these tend to get a little bit sensitive to large movements at that point. That being the case, should we break, if I'm looking at my charts, should we break this 1200 level? Yeah, maybe I would consider looking at this and putting this into M3 guidelines just to hedge off the losses to the upside this late in the trade, so we don't have something like happened in January, right? On a live trade position. We're not going to do that with this trade because, like I said, we're just doing it completely by guidelines. Most of the time they work out. So we'll go ahead and do business as usual. I was just kind of pointing that out. Let's see. We have a February M3 trade. Okay, here's a good question on the bearish butterfly. Since I'm not fully scaled in, do I reduce my profit target on this particular trade? Reality is 21 days to expiration, we technically have a reduced target anyway, and we would be pulling this off if we were in this particular position. In the meantime, normally what I'll do if I'm only in 1/3 is I'm willing to pull this off at 100% of my capital. So if I'm at about here, I'm in it for about about $10,000. So if this were to get up to around a $10,000 level, realistically, that's really all I can expect out of the market. That essentially means the market's been going my way for a really long time. And if I was, say, 29 days to expiration or 28 days to expiration like I am now, I'm up $10,000. I would probably pull the trade and kind of let it go, or possibly reconfigure it into more of an M3-ish type of a thing. But realistically, if the market's been that sideways that long a time, you're usually kind of getting lucky at that point. So not a bad idea to pull it at that. And like I said, 100% gain on a butterfly is, from an actual capital outlay standpoint, is pretty good. It's a 20% gain on a planned capital outlay, which is pretty good. So I would be willing to take that. Certainly, if the market came back to the center of this position and I'm 22 days to expiration, I'd be willing to take that. Because if I'm up $9,000 today, and I know I'm going to get out anyway if I'm at $10,000, and I know tomorrow I'm going to get out anyway, I might just take it and move on. So it's my preference to convert the bearish butterfly to an M3, adding a second third. The normal thing that I'm going to do is I have two different ways I deal with certain situations. So ultimately with a bearish butterfly, what we want is we want to catch the top of a trend. So if we have this here, I'd want to maybe enter here, get 2/3 entered. Optimally, I would like to be 2/3 entered. I'd like the market to pull back down, give me my 30% profit, and go home. That's what we're looking for. So entering this here, I like to enter again when the market's moving up, when it's pushing up fairly hard. I enter my first third. It kind of blows off a little higher. I enter my second third. Really, really good rates. The market pulls back. It only takes a very, very short time to get up 30% and move on under those conditions. If I happen to enter the first third, especially from near top of a trend, or if the market's uptrending, and it then pulls back deeply into the butterfly like it did now, all that is, in an uptrend, all that is a reset of the market. So it's just poising itself to go higher. So that being the case, if I get a deep pullback into the butterfly, it gets up over 10% or in that range, then with the reversal in the likely breakout that's going to follow, I know that that's probably going to draw me down a lot. So a lot of times in my life trading, or if it's an M21 trade, for example, I'm going to let this pull back, and then I'm going to treat the upside with M3 delta guidelines. So if I was sitting here, I'd be minus 103, which is pretty much normal. But if I went to, say, minus 150, I'd start hedging the upside off. And then if I went to, if we got to this 1230 area, I'd add the call. Then we'd be in an M3 that's up about 10+%. Even if the market takes off, you should be able to hold those gains. If the market decides to settle back into range again, normally you can get up to 20+% out of the trade, and it's a fairly safe, easy to manage trade. So I do like to do that in those particular circumstances. I wouldn't turn a bearish butterfly into an M3 trade if I entered a bearish butterfly 20 points under and the market took off to the upside. You'd be drawn down. You wouldn't get the money back. So you can do that way. And another question is, do I hedge by doing verticals or do I add calls? A lot of times when the market comes down, it has a little bit to do with how far I think the market's going to go. And it also has to do with how I can start controlling my gamma trend issue. And this actually takes a little bit of time. So I might do either. I'd say a lot of the times I want to take advantage of the volatility drop, and I would tend to do verticals. There are other times when I would when I'd want to do calls. So what I'm looking to do is I'm trying to model the perfect M3 trade. So I'll put my verticals in here. When I get to a reasonable amount of verticals in here, and by putting a call on, I have this nice flat M3 type looking of a position. And like I said, it takes a while to explain exactly what you do, but then you would just kind of hedge this off into M3. You would add your calls. So usually I'll start with verticals, and then I'll push calls in here. All right. So hi, John. With the M3, the long call with a delta of around 90 only has 149 open interest. Is this ever an issue when exiting or adjusting the long call? No, they'll exit. You'll be able to exit it even if there's low open interest. That's not an issue. I'll move 100 of those around at a time when I'm the only person in them. So, you have to remember that it is an index, and they'll make the market for it. Sometimes it will cost you a nickel or a dime more than it's actually worth. We do have a process with a wide bid-ask spread of figuring out what that call's actually worth. Sometimes it's not reflected in the mid price, right? because the mid price can change quite a bit with a wide bid-ask spread. So it's important that you understand how to price the call for maximum. I mean, you should know how to do that anyway. At some, if you're doing any of the advanced programs, and you should be able to get to fill it within 5 or 10 cents for what it's actually worth. So yeah. I mean, you're not. I mean, if you give the market maker a little bit of money to move a call, they'll move the call. So you can go from there. All right, so that is the bearish butterfly for February. Looking perfect, actually, especially if we get some sort of a fade down in the next few days. All right, let's go to February M3 position. I'll show you this because this had no adjustments until Friday. This is what we look like as of Friday. Before adjustment time, we had minus 68 delta outside the tent. So it's due for a minor delta correction, and that's all we did. So we did 5, 1140, 1150 put verticals. If we move this forward, you can see that we have put those in there. We've kicked our delta down under minus 50 position. Looks like this. And, really no concerns with this position. I actually really like it. I'd prefer not to make too many more upside adjustments. But we're just going to follow the guidelines and see what happens. Realistically, the market might come to 1225 and then pull back down into the all the way to 1150. Right, that's what it's been doing. So the longer I can stay in the position, the happier I am. But I will make the roll up if needed by the guidelines. I'm thinking about opening a 2-week M3 this morning. Is that a bad idea? What should I watch out for? It's not necessarily a bad idea. I think it's fine as long as you're entering it properly. So if you're going to do it, I'd enter it more in this position here at the edge of your tent with very flat T+0 line and plenty of downside room in case we have some sort of support break with a volatility increase. There's a good chance we're coming down. I mean, just keep in mind there's a good chance in the next 2 weeks we're coming down to at least 1150. So if you position yourself so that isn't a big deal for you, and it's also not a big deal if we run up quickly to test our 1220s, then that's perfectly fine because that's probably the most likely price movement in the next week or two, next couple of weeks. Right, actually, like I said, you could enter this now. I really like this position even if you entered the exact same one. If the market's up today, you might want to go 10 points higher. But this is nice. Okay, let's go to, again, that's no adjustments there, just that one adjustment there. I did enter, and that's all the trades we had on. Let's go to our February ROCK trade, which was entered on Wednesday. And I entered this at 1140 butterflies on Wednesday, so if we go back to Wednesday. Right, we're about 1170. Came in at 1140. Did able to do 10 butterflies in one call. Put myself at 1030 call. Put myself at about minus 10 delta, which is fine. This is, of course, we had a fairly big move Thursday, I think, right? So that put us up at 1190, but our long strike drew us down a little bit. We're pretty much at a borderline adjustment point. I could have made a minor delta correction here if I wanted to. I figured I would leave it and see what happens today. If the market doesn't come down significantly today, this is going to get some upside adjustment. But yeah, really no problem there. Nice looking trade. If we go to, let's see, our March Bearish Butterfly, which was entered on Friday as per schedule. This trade was entered in at the 1160 strikes. We had a 1-to-1 delta theta ratio, a cost of 890 for a butterfly, which is just fantastic. I actually, if somebody asked me what's the perfect conditions to enter a bearish butterfly, -7 delta per butterfly, around $9 for cost, and 1-to-1 delta theta ratio, that is just a really nice entry position from a Greek standpoint. It gives me a lot of range to the upside. I can usually withstand 100 points to the upside before maximum loss on a trade like this, which gives me some confidence, especially looking at the charting. And of course, if we come down, then it's not really an issue. So really like that entry there from a Greek standpoint. From a charting standpoint, I mean, it's okay. But I like that entry. We have a March M3. Which is going to be the same strikes here. I'm still at my 13. I ended up buying 13 butterflies instead of 10. And part of that is because, we did the bearish butterfly. You saw how low the delta was. Now with that means with the M3, it's going to be adding extra contracts in order to get my call to 90 delta. So I did 13 butterflies to one 10-20 call. This position looks like this. Again, a beautiful, beautiful M3 style of a graph. So I just have a comment of someone who got a fill on the March butterflies of 878, which happens to be less than what I filled them for here on these positions, right? Because you saw what we did with the bearish butterflies. So that's a realistic price if people are filling that live for about that amount. So what call did I buy from March? My March M3, yeah, let's see. It was this 1020. And again, this beautiful position going forward, really, really like it. And I forgot to actually enter the March M3 when everything expired. Not the March M3, the March V Condor when everything expired. So that just went on Monday. And I did this position here. We did the shorts at 1030 and 1280. We put the straddle in down here. I don't like how deep this straddle is. I can correct that by doing more contracts on the outside if I want to. Usually I don't want to. Usually if I'm underneath it, it's because the market's thinking they're going to move quite a bit. So, perfectly okay with that. I don't necessarily like it, but I can correct it if I wanted to. So this is essentially the V Condor, no adjustments, pretty much profit and loss zero. Well, actually, I guess I'm up technically $1,000, but that's really looking good. And I think that's everything. That's the March M3, the V Condor, the March Bearish Butterfly, and all our February trades. So let's see, on the ROCK trade, am I looking to get into the lowest time premium on your call under $1, or are you looking just at the delta of the call? Yeah, so I guess a question of what am I looking at when I'm entering my March M3. I mean, ultimately, right here, I'm at 94 delta, I'm at 295 time premium. I don't necessarily like to pay 295 time premium. In a low volatility environment, I'm going to run around, I would say that, yeah, I mean, I'd like to get a call under $1 in a low volatility environment. Well, what I'm really trying to do is I'm trying to balance how much money I get in the trade by how far in the money I actually am with how effective the call is, or how far I am in the money with the time premium I have to pay. And if I can get to a 90 delta and pay $1 time premium, then yeah, I will do that. That's a good trade-off for me. If I have to go, like this example here, to get $1 time premium, I have to be down under 1,000. So I have to be more than 90 points down from my actual price, which to me is just, at some point you're just kind of throwing money at it for no good reason. And I'm usually going to set that limit, at around 94 delta. This is about as deep in the money as you'll ever see me go, and it happens to cost me $295. I don't have much choice there. Now, it may not actually cost me $295 because the mid price might be off, but given the mid prices of the other ones, when the volatility is high, sometimes they'll have time premium jacked in way below where they normally do, which is what they kind of have now. So, what that's going to do is going to cause me to have to pay more time premium, and I'm okay with that. I wouldn't go with 10 butterflies necessarily, because then I'd have to buy something at maybe 85 delta. I'm looking at $10 a time premium there. That's going to make for a very, very inefficient trade. And while the trade may still work out, it's just very, very inefficient. And I wouldn't be up for that. So it's a little bit of a balance. It's not a cut and dry answer necessarily. All right, can I show the M3 again? I have 15 butterflies. Call is at 10.8. Delta is at 85. What were your values again? So my March M3, I'm assuming. I have 13 at 1160. I have 1 at 1020. Minus 776 delta. Either entry is probably fine, but it looks like, but that's the M3 trade. Selling the long call in the M3 with low open interest is fine even in expiration week. Yes, it's fine even in expiration week. I do it all the time, so not really a thing. Like I said, sometimes I might be the only open interest at a particular call at a particular level. Now, for some reason, they're not letting you out of that particular call because they know you're the only one in it. You can, which doesn't, I've never actually had that happen in the Russell. I've had that happen in stocks. You have options, right? You don't necessarily have to sell this call. I can sell a call closer to the money and actually collect some time premium for that, and just let the thing set out as a vertical. If the trade goes against me, I can just again roll that call down a little bit lower until they do decide that they're willing to let me out of this call. But I've never experienced that in a Russell, and I've done like 100 of them when I was 100. That was me. That's all there was. And on the day of expiration. So you can do that. But there's nothing wrong with selling a call a little bit higher. If I'm so deep in the money on expiration day that, say, I don't know, I guess I can't go to February here, but say it's next to expiration and, I'm at 1,000 call and the market's at 1190. Realistically, that call doesn't have any danger of having a problem. It just has a danger of losing value on the downside. So I could sell something at 1110, which also has no chance, really. With the market at 1190 from Monday to Tuesday, the market has no chance of hitting this 1110 area either. So I could sell a call there. I could just keep my call at 1100. Maybe collect a little bit of time premium and just, but probably not. But if no other reason, I've taken all the risk off of that call for a very long move to the downside. So sometimes you just think about being flexible with what you're doing. Did I enter the ROCK as M3? Yes. How do we determine what to do? An M3 or a modified ROCK? A modified ROCK is only going to happen under extreme volatility, like if you are in a position where the market's moving like 150 points in 3 days. After the 2011 crash, during the 2008 crash, if you were to enter a ROCK trade after the flash crash, those are the only times in the last 10 years you'd even be in that position. And again, you could decide whether you actually wanted to be in the market if the market was moving that much, but that modified ROCK position is a safe way to enter in the market in those conditions. Essentially, your delta would be so flat that you wouldn't even want to buy an M3. Like if you had to do 25, 30 contracts on an M3 to get one call, that is where you'd be looking at maybe a modified ROCK type of a thing. Then, like I said, I'm not going to be able to go through the exact rules on how to determine that, but generally you wouldn't be in that position unless there was something really serious happening. Do I ever finance the M3 by selling a put? No. It just adds more. You could do that. Synthetically, you're just a long call at that point, but it actually doesn't react the same either. I mean, just because the position sometimes is synthetically the same, they don't always react the same way. But no, I don't personally do that. If I wanted to, dealing with margin issues, I could just buy a futures contract in the TF or something too. So there's a lot of options with that. But no, I don't ever do that. And I believe that is all the questions we have. Thank you for joining me, everybody. And look for me next week. Have a great day, everyone.